Welcome back to the Investing Talk podcast. Today, we are taking a close look at a stock that's been, well, lighting up the growth charts this year, SoundHound AI. And we've got a pretty clear mission for this discussion. We want to really analyze the growth potential, look at the significant risks too, and try to answer that critical question on a lot of investors' minds right now. Is this actually a good time to buy SoundHound AI? Before we jump in, just a quick request. If you find this kind of analysis helpful, please hit subscribe, maybe like this discussion, and definitely leave us a comment. We really do enjoy hearing from you. And look, if there's a specific company you'd like us to analyze in the future, just drop its name in the comments. We'll see what we can do.
Absolutely. Okay, let's set the scene for SoundHound AI. It operates in, well, it's a very competitive space, conversational AI. What jumps out right away from our sources is this kind of massive contradiction. On one hand, the company gets this really optimistic, bullish 910 rating that suggests strong conviction. But on the other hand, our data shows unusually high volatility and honestly, some really counterintuitive price movements recently. So our goal today is to unpack that contradiction for you. We want to figure out if the fundamental story really justifies the risk you'd be taking.
Yeah, 9 out of 10 rating. That's pretty rare. It sounds like serious conviction from the analysts. But, with all the turbulence around AI stocks, generally, we need more than just a rating. We need concrete evidence. Okay, so let's start unpacking this. Let's begin with the fundamentals, the core growth story. Look at the financials, the trailing 12-month revenue, the TTM number. It's at $131.45 million, which is a solid number. But the real story, the thing that really got the market excited, was the guidance they raised. Management's now targeting full-year 2025 revenue between $160 million and $178 million.
And that guidance, that's really where the bullish rating starts to make sense, you see. If you look at the midpoint of that range, it represents, well, pretty stunning year-over-year growth. We're talking 22% to 35%. And just to put that in context, that rate is significantly beating the general industry averages. It suggests really rapid structural adoption of their platform, especially through those high-value, long-term contracts they're signing. Definitely illustrates why there's so much optimism around the name.
Okay, 22 to 35% growth. That's definitely impressive.
We absolutely have to provide the financial counterbalance right away. This is still very much a growth story. It's in what we'd call an investment phase.
Yeah.
When you look at the bottom line, it tells a very different story. We're seeing substantial TTM net losses, a massive $225.44 million. And the EPS, the earnings per share, is negative 0.0559 cents. Now, if you're a more conservative investor, that kind of loss is a definite red flag.
Wow, minus $225 million. That is a staggering loss. So what concrete evidence are analysts hanging their hats on if the company's bleeding money like that? Is it just, blind faith in the whole AI?
Well, the market seems to be interpreting it as strategic investment, not really blind faith. The tolerance for that level of loss seems tied directly to building their long-term competitive advantage, their moat. That loss primarily reflects massive R&D spending, which they need to develop and perfect their proprietary advanced AI model.
Okay, so spending money to make money, essentially. But is there evidence it's working?
The good news is, operational efficiency is improving already as those top-line revenues scale up. And crucially, margins are expected to gradually recover. This happens as those high-margin, sticky SaaS contracts, software as a service, start to scale up. And as that initial, really aggressive R&D investment begins to normalize. So the market is essentially betting that the future profits from these current contracts will quickly, outpace these investment costs.
So the thesis is pretty straightforward then. The current losses are basically the entry fee to build a future profit machine.
Exactly. And importantly, they seem to have the capital to keep playing that hand. Their balance sheet is described in our sources as healthy, which supports their ability to sustain this reinvestment period. And that helps underpin their pretty substantial $7.27 billion market capitalization. They don't seem to be in immediate financial distress, allowing them to keep chasing that high growth.
Right. And connecting this to the immediate future, the next really critical financial event, the one that could either validate or undermine this conviction, that's the Q3 earnings report scheduled for November 11, 2025. Investors are going to be watching that very keenly. They'll be looking for concrete evidence of continued sequential acceleration in new contracts and maybe most importantly, signs of margin improvement.
Okay, so moving from the financials to the actual product, let's try to define that competitive advantage. The structural defense, the moat that analysts believe justifies this high valuation despite the losses. SoundHound AI's proprietary platform, it's called Houndify. Now, this isn't just another ATI. It's described as an ecosystem that allows for unique, customizable, and this is key on-device voice AI experiences.
Okay, let's pause on that on-device part, because that often seems to be the single biggest differentiator here. Why can't, a giant like Google or Amazon just use their huge cloud infrastructure to do the same thing? What makes on-device so powerful?
Well, it really comes down to two things: physics and regulation. First is latency, the delay. In many applications, think about driving a car or maybe mission-critical systems in a business, you need an instantaneous response. If your voice command has to travel all the way up to a cloud server and then back down, you introduce delay. SoundHound's approach allows processing right there, on the chip itself. It reduces latency to almost zero.
Ah, okay. Speed matters.
Definitely. And the second reason, maybe even more powerful, is privacy. In regulated industries, automotive, healthcare, certain government sectors, you just can't afford to have sensitive user data constantly being sent to a third-party cloud. On-device processing ensures crucial privacy and security.
Yeah.
And that's a requirement that the big cloud competitors can't easily fulfill while sticking to their current business model.
Okay, that paints a much clearer picture. So we're talking about specific high-value industries where security and speed are basically non-negotiable.
Yeah.
That gives SoundHound a distinct edge over the more general broad market cloud AI players. It's a very specific technical moat. Right, now let's shift gears a bit and look at the technical picture. As of October 3rd, 2025, the stock closed at $17.84. Our sources describe a remarkably robust bullish pattern here. We've seen really consistent action, higher lows and higher highs over the last 3 months. That shows incredible momentum, especially after bouncing dramatically from a yearly low of just $4.45 up to a recent high of $24.98. I mean, that's a powerful run.
It is a powerful run, and for those looking at this from maybe a short to medium-term perspective, the projected trading range for the next 3 months is quite wide. It's suggested between $14.50 all the way up to $24. That wide range itself reflects the inherent volatility we're talking about today.
Okay, so a wide range implies opportunity but also risk. We need to know the lines in the sand, so to speak. Where does the technical analysis suggest investors should kind of anchor their expectations?
Well, key support right now seems to sit near that $13.50 to $15 zone, and that aligns pretty closely with the 50-day simple moving average, the SMA. Meanwhile, resistance looks concentrated up near 21.50 cents and that recent high around $24.
And what about the moving averages themselves? Do they confirm the trend?
Yeah, if we look at the momentum indicators, they definitely confirm the sustained bullish run. The 50-day SMA is currently sitting at the $13.78, and the 200-day SMA is even lower at $12.30. The fact that the stock is trading pretty comfortably above both of those lines confirms the established uptrend looks solid, both fundamentally and technically speaking.
What about the short-term entry point, though? We keep mentioning the high volatility. So what does the relative strength index, the RSI, tell the average investor about whether the stock is, too hot right now?
What's fascinating here, actually, is that the 14-day RSI is currently at 43.45. Now, if the RSI was up above 70, we'd typically call that overbought and expect a pullback pretty soon. But an RSI near 43 suggests, well, healthy momentum without being immediately overheated. So technically speaking, this implies there's still room for the price to appreciate before a major, technically driven pullback is signaled.
Okay, so that brings us perfectly to the core paradox we started with. Despite the reassuring technical health and the strong fundamentals we just discussed, the average volatility remains really high, around 12.25%. We saw shares surge, 23.5% in September alone. That was after the blowout Q2, and that raised guidance. And analysts agree. The consensus is a strong buy. So why the disconnect?
This is where it gets really interesting and, frankly, potentially confusing if you're just looking at the fundamentals. We've seen some contradictory recent price action that just screams meme stock dynamics.
Oh.
It looks like sentiment and, frankly, social media action are currently sometimes overriding actual operational success.
Okay, give us examples. What specifically happened?
Let's look at 2 critical examples just from September. First, on September 9th, the company announced they were acquiring Interactions. This was a strategic move meant to enhance their core AI tech. Fundamentally, that's positive news, right? Strengthens the moat. But what happened to the stock? It declined 5.4%.
Wait, hold on. A positive strategic acquisition sends the stock down. That's the first sign of potentially irrational movement.
It gets worse. Example 2. On September 23rd, they announced a really significant operational win. Red Lobster adopted their telephony ordering system. Now, this isn't just simple voice-to-text. This is SoundHound's proprietary AI, handling high volumes of different regional accents, integrating complex menu systems instantly. That's a huge, recognizable brand validating their tech in a high-value area. So what happened?
Let me guess. It went down.
The stock fell a stunning 13% over the next 2 trading days.
Wow. A major operational contract win that validates their core product sends the stock plummeting. That's completely counterintuitive. Are we looking at a stock that actually punishes good news sometimes because of short-term trading dynamics?
That is precisely the aha moment for you, the listener. These incidents really demonstrate that current investor sentiment, which seems driven by a mix of, genuine excitement but also rapid short-term profit-taking, can sometimes completely outweigh significant operational news. It seems like the initial news spike draws in traders who then maybe immediately sell when the news is confirmed, creating these complex, counterintuitive trading signals. It really feels like a battle between patient long-term money and hyper-fast short-term money.
Right.
We see this reflected in institutional movements too, by the way. Some wealth management firms have reportedly been selling shares, probably locking in gains after that massive run-up from the lows. They're booking profits.
But that contrasts sharply with the insider activity we've heard about, doesn't it?
Absolutely. That's the other side of the coin. At the same time, we've seen reports of consistent insider buying at strategic price levels. That signals deep confidence from within the company. And we've also seen increased institutional inflows overall since the summer of 2025. So it really is the ultimate battleground. You've got some institutions selling, perhaps locking in temporary gains, while insiders are buying, signaling long-term belief. It suggests the recent weird price action might just be short-term noise.
That clarification helps. I mean, if the people closest to the product are putting their own money in, that's usually a powerful signal, even with the volatility. Okay, let's pivot now and focus on the immediate future. What are the short-term triggers over the next, say, 0 to 3 months? These are the catalysts that could drive the next wave of volatility and potentially upside. Well, the first, and probably most crucial, is that Q3 2025 earnings report on November 11th. If those results confirm the strong guidance we talked about and importantly show margin improvement, that could be a massive sustained trigger for the stock. Second, we have the major ETF quarterly rebalancing happening around mid-November 2025. That kind of index event can cause significant volume shifts and volatility just based on fund allocation changes alone.
Right. And beyond those scheduled events, investors should probably keep an eye out for expected product launches and any new partnership announcements. Our sources specifically point to ongoing activity in that automotive vertical, trying to land major OEM wins, and also efforts around international expansion. Remember, the auto industry really needs that low latency, high privacy, on-device capability we discussed earlier. That's their sweet spot.
Any speculative buzz to be aware of? Stuff that might move the needle short term.
Well, there's always speculative buzz with stocks like this. While it's unconfirmed, of course, there's ongoing chatter about the potential for a large-scale deal, specifically with a major European automotive manufacturer for their in-vehicle voice assistant. And furthermore, there's just persistent speculation about a potential strategic acquisition, maybe by one of the major cloud providers looking to quickly bolster their own conversational AI offerings. Now, these rumors, whether they turn out to be true or not, they definitely drive trading action and add to the volatility.
Okay, so bringing this all together then, we have high growth fundamentals, check. A unique technology moat, check. A wave of near-term catalysts coming up, check. But we also have this incredible volatility driven by sentiment that sometimes makes the stock drop even on good news. So what's the final synthesis? What's the takeaway for someone listening right now considering an investment?
Well, the reason our sources rate the company bullish 910 is because it successfully combines those high-growth fundamentals, that 22% to 35% projected revenue jump, and that unique tech moat, with powerful technical momentum that we saw in the charts. So the investment thesis seems to be that this company is potentially attractive for both short-term tactical trading, trying to leverage those imminent Q4 catalysts, and for longer-term positioning to capture the ongoing disruption in the voice AI space. It's definitely a conviction stock where the core technology seems to warrant the high valuation. But, and this is a big but, you absolutely must be prepared to manage the intense swings driven by those short-term market dynamics and profit takers.
That sums it up perfectly, I think. SoundHound AI is clearly a high-risk, high-reward proposition. The growth potential and the innovation seem undeniable, but the day-to-day price action is heavily dictated by market volatility and that fast-moving, sometimes counterintuitive sentiment.
Which really raises an important question for you, the investor, as you try to decide on an entry point. Given the evidence we've seen that positive operational news, like that Red Lobster deal, has recently led to steep price drops because of profit-taking and maybe meme dynamics, how should you strategically weigh that sustained long-term revenue growth projected between 22 and 35% against the immediate unpredictable risk of this short-term volatility? Is the current price actually a better entry point if you believe in the long-term fundamentals, even accepting the risk of a temporary drop? Or is it simply too high risk given the speculative nature of the short-term events driving it right now?
Food for thought, indeed. That's exactly the kind of high-stakes balancing act required in today's AI-driven market. Thank you for walking us through this analysis of SoundHound AI. We appreciate the insights, and thank you for listening. We'll catch you next time on Investing Talk Podcast.